Hi everyone, and welcome back to My Money, Your Investment channel. And thank you for joining me for another valuable episode. In today's program, we have something very interesting and important to discuss, so make sure you watch till the end. You've probably seen the news, tensions between the United States and Iran are escalating. But you might be wondering, what does that have to do with us here in Sri Lanka? Well, quite a lot actually. When oil prices rise, we feel it at the pump. When global markets shake, our rupee reacts. And when instability hits the Gulf region, our overseas workers and their families could be affected. Today, we're connecting the dots, from global conflict to local impact. And don't forget to subscribe, share, like, and comment our channel. So now it's time to move for deep dive.
You are watching My Money, Your Investment channel.
Okay, so let's unpack this. It is late February 2026, and if you've glanced at your phone or turned on the TV or even just walked past a newsstand in the last 48 hours, you know exactly what is dominating the conversation. No, you can't. We are looking at a major escalation in the Middle East. I mean, coordinated military strikes by the United States and Israel against targets in Iran.
And of course, the subsequent missile volley coming back from Tehran.
Right. It's the headline everyone feared.
It really is.
Yeah.
And unfortunately, it's the one we've got right now. It is arguably the most volatile, tense moment the region has faced in a decade, maybe longer.
I would definitely agree with that. And usually, when the sirens go off in the Persian Gulf, the analysis sort of just stays there. Exactly. We look at the blast radius or the military strategy or the diplomatic fallout between Washington and Tehran.
Which is natural, of course.
Of course. But today, for this deep dive, we're going to do something a little different. We're zooming out, way out.
I like this approach.
Yeah, we're going to trace the shockwaves of those explosions all the way to an island nation thousands of miles away. Sri Lanka.
Which I know might seem like a strange pivot to some of you listening.
Right. I mean, I wouldn't immediately link these two. Why focus on Colombo when the fire is in the Gulf?
Exactly. But when you dig into the data, and we have an absolute mountain of economic reports and trade analysis here in front of us, you realize that this isn't just a military conflict.
No, it's much bigger than that.
It really is. It's a textbook case of economic contagion.
Contagion. That's the perfect word for it, actually. The mission today is to map that infection, essentially. We want to understand how a missile strike in the desert ends up emptying wallets in Jaffna.
Or causing panic in a tea auction in Colombo.
Right. How does that happen?
Well, it's a case study in hyperconnectivity. You can be geographically safe, and obviously Sri Lanka is nowhere near the blast zone, but economic...
They're right in the crosshairs.
They are right in the crosshairs. And for Sri Lanka, the ties to the Middle East aren't just strong, they are structural. They are the plumbing of the entire economy.
The plumbing. And that plumbing is looking pretty fragile right now. So let's start with the most obvious link in the chain. The one that hits you the second you start your car or pay your electric bill.
The black gold.
Oil.
Yeah, oil. Energy is always the first domino to fall in these situations. To understand why this hits Sri Lanka so hard, you have to look at the map.
Okay.
Specifically, you have to look at one narrow strip of water, the Strait of Hormuz.
The choke point. We hear that name every time there's tension, but just remind us why it matters so much.
It matters because it is the jugular vein of the global energy market. I mean, it's barely 21 miles wide at its narrowest point, but something like 20% of the world's total oil exports pass through there.
Every single day.
Every single day.
And Iran is sitting right on the northern shore of that bottleneck.
Precisely. So when you have U.S. and Israeli strikes on Iranian soil and Iranian retaliation, the shipping insurance markets just go berserk.
Even if nothing is actually hit yet.
Yes, and this is key. Even if not a single tanker is actually sunk, the fear that one might be sunk drives the price up immediately.
So it's the risk premium.
That's the technical term, yeah. It's basically a fear tax. Traders in London and New York will look at the news, they see missiles, and they automatically bid up the price of futures contracts to hedge their bets.
Just reacting to the fear.
Completely. We are already seeing benchmark Brent crude smashing through multi-month highs this week, just on the speculation alone.
Yeah, the source material we have is projecting some pretty scary numbers. They're talking about breaching the psychological barrier of $90, maybe even $100 a barrel if this conflict widens or drags on.
And you have to realize for the US or Europe, $100 oil is painful. It's annoying. It hurts the wallet.
Right, you complain at the pump.
Exactly. Yeah. But for Sri Lanka, it is a metabolic shock. You have to remember, Sri Lanka has effectively zero oil reserves of its own to fall back on.
Zero. Right, they're not pumping anything out of the ground at all.
None. Every drop of petrol for a tuk-tuk, every liter of diesel for the power plants, every bit of kerosene for cooking in rural areas, it all comes on a ship.
And it all has to be paid for in foreign currency, usually US dollars.
Exactly. This is where the mechanics get absolutely brutal. Sri Lanka is an import-dependent economy for energy. So when the global price spikes, the national import bill doesn't just go up a little bit.
It skyrockets overnight.
It skyrockets. The government has to suddenly find millions of extra dollars just to keep the lights on and the wheels turning.
And we know from the very recent past how difficult it is for Sri Lanka to find extra dollars anywhere.
That's the context we really can't ignore here.
Right. We are only 4 years removed from the worst economic collapse in the country's history. The scars from 2022 are still very fresh.
That's what makes it so dangerous. It's not just the math, it's the psychology. We have reports coming in from late February 2026 describing queues forming at petrol stations in places like Jaffna.
Even if there isn't a physical shortage yet.
Right supply might actually be okay for the moment, but the sight of a price hike triggers a collective PTSD.
People remember the days of sleeping in their cars for fuel. I mean, they remember the QR codes and the severe rationing.
They do, so you get panic buying, you get hoarding, and that artificially strains the supply chain even further.
It's a self-fulfilling prophecy.
It really is. But even beyond the panic, the inflation mechanics are inescapable. We call this cost push inflation.
Okay, let's break that down for the listener. Cost push. It sounds super technical, but it's actually pretty intuitive when you think about it.
It is. It's simple but devastating.
Yeah.
It's not that people are suddenly buying way more stuff.
Because that would be demand inflation.
Exactly. This is different. The cost of making or moving things has gone up. If diesel costs more, the truck driver has to charge more to move vegetables from Dambulla down to Colombo.
And the bakery has to pay more to run their ovens?
Spot on. The bus ticket costs more. Suddenly, the price of everything rice-style bread, it all creeps up.
Not because the food itself is scarce.
Right, but because the energy required to get it to you is more expensive.
So it effectively acts like a tax on the entire population, and it hits the poorest the hardest. And it's happening right when people were hoping for some relief, finally.
Yes, and at the macro level, it drains the country's foreign reserves. Every extra dollar spent on oil is a dollar that can't be spent on medicine or industrial raw materials or debt repayment.
Which brings us to the other side of the ledger. If oil is the money going out, we really need to talk about the money coming in.
Earnings.
Right. Because there is a massive revenue stream that flows directly from the Middle East to Sri Lanka that is now completely in jeopardy.
The remittances, the silent engine of the Sri Lankan economy.
I really think people outside the region don't grasp the scale of this. We aren't just talking about a few expats working in banking in Dubai.
No, we are talking about a demographic force. There are over 1.5 million Sri Lankans working in the Gulf states right now. Saudi Arabia, UAE, Qatar, Kuwait.
1.5 million. In a country of 22 million people, that is a staggering percentage of the workforce.
It is huge. And these aren't just casual workers, they're breadwinners. They were sending cash home every single month to their families.
And the numbers we saw in the research.
These remittances generate over $5 billion annually for Sri Lanka.
$5 billion, that's not pocket change. That is a foundational pillar of the entire economy.
To put that in perspective for you, that covers a huge chunk of the country's trade deficit.
It does.
It's the lifeline that allows families to build houses, pay for education, and literally buy groceries.
It's absolutely critical. It's one of the main ways Sri Lanka gets the foreign currency it needs to buy that medicine and expensive fuel we were just talking about.
But now look at the situation.
Right, you have a war breaking out in the very neighborhoods where these 1.5 million people are living and working. So what happens to that lifeline?
Well, the sources we have outline a few scenarios, and honestly, none of them are good. They range from bad to catastrophic.
Okay, start with bad.
The immediate bad risk is an economic contraction in the Gulf.
Right, because if Dubai or Riyadh goes on to a war footing, business naturally slows down.
Exactly. If uncertainty rises, companies stop hiring, they might cut shifts, construction projects get put on hold, And if you are a contract worker, which most Sri Lankans there are, you are often the first to be let go.
And no job means no remittance. The flow of dollars just stops.
It stops. And if you lose your job in the Gulf, you can't just hang around. You often have to leave.
Which brings us to the catastrophic scenario.
Yes, the darker worst-case scenario mentioned in our notes is mass evacuation.
This is the nightmare scenario. If the missiles start flying closer to these population centers, Sri Lanka might have to physically bring those people home.
And think about the economics of that for a second. Not only do you lose the $5 billion revenue stream overnight, but you suddenly have to spend millions to evacuate over 1 million people.
Wow.
Yeah, it turns a massive asset into a massive rescue cost almost instantly.
That is a terrifying prospect. It's literally like a pincer movement on the economy.
That's the perfect term for it, a pincer movement.
Right.
On one flank, you have the oil price shock attacking your reserves, forcing you to spend more dollars just to survive.
And on the other flank, you have the remittance shock.
Exactly, meaning you are earning fewer dollars.
So you're burning the candle at both ends, essentially.
And for a country like Sri Lanka, which is still in a fragile recovery phase, that double blow fundamentally undermines the ability to import essentials.
It's not just about losing savings.
No, it's about the country's ability to function at a basic level.
Okay, I want to pivot slightly and touch on a few other sectors that might get caught in the crossfire here. We've got oil and we've got workers. What about trade? We know Sri Lanka is world famous for its tea.
Ceylon tea, a massive global brand. And where does a huge chunk of that tea go?
The Middle East.
The Middle East.
So if I'm a tea exporter sitting in Colombo right now, am I sweating?
You should be cautious, certainly. The risk here is twofold. It's about demand, and it's about logistics.
Walk us through that.
Well, if the buyers in the Middle East are facing financial instability because of the war, they might just buy less tea. It's a luxury in some ways. But the bigger issue is actually the payment process.
Ah, the plumbing again.
Exactly, the plumbing. If the banking systems in the region get jittery transfers slow down, I mean, sanctions on Iran are already a headache for traders.
Yeah.
But if the wider region's financial networks face cyber attacks or shutdowns,
Which is a hallmark of modern warfare.
right, getting paid becomes an absolute nightmare.
And what about the physical shipping of the tea?
That's the other hurdle. If insurance rates for shipping tea into the Persian Gulf skyrocket because of the missile threat, it wipes out the profit margin entirely.
Ships might simply refuse to dock.
They might. Currently, government sources claim that export processes are fairly resilient. It's not a total shutdown yet.
Right, we aren't at zero.
No. But the friction is increasing. Every transaction becomes a little harder, a little riskier, and a little more expensive.
Speaking of things moving, let's talk about people moving. Tourism.
Huge sector.
Yeah, and this is one that I found really interesting in the research because, again, most tourists in Sri Lanka aren't coming from Iran or Israel. They're coming from Europe, India, China. So why does a Middle East war hurt a boutique hotel down in Galway?
It's the transit problem. Or you could call it the hub and spoke problem. If you look at the flight paths for European travelers coming over to Asia, where do they stop?
Dubai, Doha, Abu Dhabi.
Exactly. These are the mega hubs of global aviation. Even if the war isn't happening in Dubai itself, if the airspace over the wider region becomes contested or dangerous, airlines have to reroute.
And rerouting means longer flights.
Longer flights mean more fuel. And what does more fuel mean?
Higher ticket prices.
Higher ticket prices.
And higher ticket prices mean that a family sitting in London or Berlin might look at the cost and decide, you know what, Sri Lanka is just too expensive to get to this year. Let's go somewhere closer.
Precisely. It cools demand almost instantly. And remember, Sri Lanka is heavily banking on tourism for its GDP growth.
It's a massive employment sector there.
It really is. So if the Middle East hubs get clogged up or become too expensive to fly through Sri Lanka, loses customers. It's pure collateral damage.
All right, so we've looked at the specific sectors: oil, remittances, trade, tourism. But I want to zoom out for a minute and look at the macro view.
The big picture.
Yeah, because when a war starts, the big money on Wall Street and in London moves in a very specific way, doesn't it?
It does. It's a phenomenon called the flight to safety. When investors get scared, and war obviously makes them very scared, they dump risky assets.
They want stability.
Yes. They sell off investments in emerging markets, and they run to the things they trust the most: gold and U.S. government bonds.
They want the sure thing, the bedrock.
It's exactly the bedrock. And what happens when everyone in the world starts buying U.S. bonds? The U.S. dollar gets stronger.
And this is where the currency math really hurts Sri Lanka.
Correct. because when the US dollar strengthens almost by definition, the Sri Lankan rupee weakens in comparison.
So let's trace that back to the very start of our conversation. We already said oil is getting more expensive globally because of the war. Now you're saying the actual currency Sri Lanka uses to buy that oil is getting weaker at the exact same time.
That is the vicious cycle. You need more rupees to buy the same amount of dollars to buy more expensive oil.
That is brutal.
It is. It amplifies the inflation we talked about earlier. It makes everything significantly harder for the central bank to manage.
And we really have to place this in the proper historical context. You mentioned this term earlier, fragile recovery. Sri Lanka isn't starting from a position of economic strength here.
No. And that is the crucial context for all of this. If this were 2015 or maybe 2010, maybe the economy could absorb the shock a bit better.
Right, they'd have a buffer.
Exactly. But we're looking at an economy recovering from the highly tumultuous period of 2019 to 2024.
The sovereign debt crisis, the severe currency depreciation.
The scars are literally still healing.
So this war is hitting a patient that is just getting out of the ICU, basically.
That's a very fair analogy. The timing is particularly bad. The stabilization efforts that they put in place were just starting to bear fruit, and now this massive external geopolitical storm hits.
It threatens to undo some of that hard-won progress.
It does. It forces the central bank to make impossible choices. Do you raise interest rates to defend the currency? Well, that kills economic growth.
Right. And do you let the currency slide?
Well, that causes rampant inflation. There are no good options left on the table. Less bad ones.
It really highlights how connected everything is. You can't just fix your own house and expect to be totally safe if the neighborhood is on fire.
No, you really can't. It essentially dismantles the idea of a fully independent economy. In 2026, there is no such thing as a local conflict. Every war is a global economic event.
Okay, so let's try to summarize this for everyone listening. We've covered a lot of really complex ground today.
We have.
If we had to boil this down to the key takeaways, the 4 pillars of this crisis, what are they?
I'd say there are 4 main pillars of impact here. First is oil.
Okay, oil.
The war drives up global prices, which in turn drives up Sri Lanka's import bill and causes domestic inflation. Second, remittances. The 1.5 million workers in the Gulf are at risk, which directly threatens a $5 billion lifeline of foreign currency.
A huge vulnerability.
Their logistics. Trade and tourism are disrupted because the transit hubs and shipping lanes are in the danger zone. It just becomes harder and much more expensive to move people and products like tea.
And finally,
the macro view. The global flight to safety strengthens the dollar and weakens the rupee, making all those necessary imports even more painful and complicating their whole debt recovery process.
It's an incredibly sobering list. It really drives home the point that in 2026, there is no such thing as a local conflict.
Absolutely. Geography separates Sri Lanka from Iran, but the global economy brings them together tighter than...
And that actually leads me to a question I've been mulling over while we've been talking. Yeah. We often talk about resilience in terms of domestic policy, right? Like saving money, building good infrastructure, growing your own food. Right, the standard playbook. But does this situation prove that a nation's stability is actually held hostage by the geopolitical stability of its trade partners?
Big question.
I mean, if your economic lifeline is remittances from a volatile region, does that lifeline become a noose during a war?
It really forces you to ask some hard questions. Does the entire economic model need to be rethought? Can you afford to be so reliant on a single region for both your energy and your income?
It's a massive risk.
It's a huge risk. It's a tough question, but one that Sri Lanka and honestly many nations right now need to grapple with. Is it time to pivot to new markets? Or is that just a pipe dream in such a polarized world?
It's a massive, massive question, but it's exactly the one that needs to be asked right now. We will leave you with that thought to mull over. Thanks for diving deep with us today.
Thank you. Stay curious.